The one indicator that is never wrong. What if I told you that there is one indicator that has never been wrong in predicting the price of the stock market in the future? What if I told you that it's incredibly simple to read? A bearish sign ahead occurs in the future when the indicator crosses below zero, and a bull market ensues when the indicator is above zero? It's pretty simple. If you want to know more about how to use this indicator in your trading, keep watching. The indicator that I'm talking about is the 10-year Treasury constant maturity minus 2-year Treasury constant maturity. Okay, that's a mouthful. Let me first explain what that is. When the yield spread is positive, meaning the 10-year yield is higher than the 2-year yield, it suggests a normal or upward sloping yield curve. A yield curve is typically upward sloping because bonds with longer maturities usually carry higher risks and have higher yields. This indicates that investors expect the economy to grow and inflation to remain relatively stable in the future. On the other hand, when the yield spread turns negative, with the 2-year yield higher than the 10-year yield, it suggests an inverted yield curve. This is considered a potential warning sign of an economic slowdown or recession, as it implies that investors are seeking the safety of short-term bonds due to concerns about future economic conditions. The actual yield curve is a little more hectic to look at, but you still get the idea, and you can see from the chart below that we first went inverted Friday, April 1, 2022, and then again starting July 6 of 2022. This indicator has predicted every major recession. Okay, if I'm being fair, even though this indicator has never been wrong in forecasting a recession, its flaw is that it doesn't tell you when that will happen. It's not as easy as selling the market when the yield curve goes below zero, because we don't know exactly when the recession will start, just that one should be arriving, typically in 12 months or so. Technically, that means we're already 2 months into the recession from the initial April 1, 2022 inversion date. Or, are we? Let's look back at the last time we were inverted by more than 1% was in the early 1980s, also when inflation was running rampant. The shaded areas are periods when the US entered into a recession. Each time before the shaded area was a period when the yield curve was inverted. Let's zoom in closer to the late 1970s, early 1980s. The yield curve inverted on August 21, 1978, and dropped below 1% on October 15, 1979. The US entered a recession in January of 1980. The following 1981-1982 recession was the worst economic downturn in the US since the Great Depression, and it was triggered by tight monetary policy. Sound familiar? Now, 1975 to 1980 was a very different time in the market compared to the last 5 years, so will everything play out the same way? I don't know, but there was a brief attempt at a rebound toward the end of 1980 before the bottom dropped out in 1981. Will something similar happen in October of 2023? That's what I'm trying to warn people about ahead of time. Yes, the market has entered a technical bull market, and the overall trend is higher today thanks to artificial intelligence stocks. Yes, the last 5 years are vastly different from the late 70s, but don't let your guard down. The yield curve is never wrong at predicting recessions, but it's not the greatest in pinpointing an exact date. Keep trading what the tape gives you, but understand the backdrop of the broader market environment. Given the recent market conditions, I decided to look for a bearish trade today. I'm looking at Tractor Supply Company, TSCO. The stock is trading mildly lower than it was 6 months ago and flat over the last month. It's below its 50-day and 200-day moving averages. It's technically overbought at these levels too. Therefore, I'm looking for a continued bearish move over the next 2 months. I know it's not something we do at Traders Reserve often, but I'm looking to go buy a short put spread. That means I'm buying an at-the-money put that will profit as the price of the stock goes lower, and I will offset the cost of purchasing the long put by selling a short put to bring in credit. For more information on this trade idea and others like it, visit tradersreserve.com.